This is Professor Hazara again, and this is the fourth video in this series of videos on doing a rather rudimentary full pro forma evaluation, which we will then keep mentioning, which we will then can make adjustments to, depending on how you want to do the final evaluation. The choices are all yours. Okay, this is the one that's going to be a little longer because it's going to be, we're going to make a statement of cash flows, but it's going to be a very rudimentary statement of cash flows. And notice that I put all the accounts here that I'm going to put on. And what I did here is I just copied down the accounts from the balance sheet, right up to the balance sheet, and I copied the accounts that actually changed. You don't have to do subtotals, obviously, because you'd be double counting. But for the ones that I used the base formula, those are the ones that I copied down. If I held them constant, like goodwill here or intangible assets, I don't have to put them in at this point to the statement of cash flows because they'd be zero anyway. And that's why I kind of did that, to just start this very rudimentary model, and then we'll, as we go through the course, let's see how we can adjust this. Okay, so right now, what I've done is I've copied down all the current assets and current liabilities. There's a few long-term asset liabilities which change, which use the base formula. And of course, I'm not going to do cash because I'll be reconciling that. Okay, so let's go ahead and start. Okay, let's first go ahead and start by, I'm just going to go ahead and I'm going to copy down my years here. Yeah. I'll see if I can do this and change the format. Like that. Okay, good enough. Looks good. Okay, so we'll put it in the right line. And then, so the next thing we'll do is we will go ahead and just go up to the income statement and pull down the income statement. Pull down the net income. The net income is that number right there. Okay. Well, we're here and putting that number right there. Okay, and now we've got to change the working capital. And like I said, I only put in the numbers for which there was a change, and I held some constant on purpose. I didn't know what they were, and it's good to make a model that works mechanically first, and then you make the adjustments. Okay, short-term investments. It's an asset, so it is going to be. I'm going to take. I don't have to do 2020. I have to do 2021. So I'm going to take, for all the asset accounts, I'm going to take the, since I'm going the opposite direction, I'm going to take that, the beginning balance less the ending balance, and that should give me my change right there. So for short-term investments, that looks good, 20533. Okay, and then I'll go out there, and so far it does match my worksheet. I'm going to go ahead and I'm going to take a little bit of a gamble here and just see if I can just copy down accounts receivable. No, for some reason, oh, because there's a subtotal there. So that's why I say be careful with subtotals. So this next one is going to be equal to, once again, see, I was copying down that subtotal there. Going to be equal to that, the initial accounts receivable less the beginning less the ending, which will give me the opposite effect. That's 53.46. That looks good. Corresponds to the sheet. Obviously, I've obviously done this already. That's minus 9915. Okay, now let's see if I can copy some of these lines down to save some time. Okay, so that's inventories. -316. That looks good. I'm going to do it one line at a time. We'll do the next two lines. Try the next two lines. Okay, so those so he's got that 3556, and this line doesn't work. Oh, that's because it's a payable. That's why it's dangerous. Got it. Okay, so we've got that. So let's make sure we've taken care of all the current assets. We've taken care of short-term investments, which, by the way, probably in real life we'll shift it down to the investing section of the statement of cash flows. Accounts receivable, inventories, and other current assets. Take care of that. let's now take care of our current liabilities. And you only have 1, 2, 3, 4, 5, 6. Well, you have 6 current liabilities. And you could just take the total, but I like to start with the detail because then you can reformulate it whatever way you want. Okay, so for the liabilities, we will do the opposite. We will subtract the beginning balance from the ending balance. So we'll go the ending minus the beginning should give you 2093 there. Okay, and so we'll do that, and that looks good, 3881. Okay, then I'm going to see, I think those were all in a row here. So I'm going to try to copy this down. I don't think there were any subtotals intervening here. Okay, so if these two last numbers match, then we should be fine. Yep. So all I did for all of these was I took, you can see the ending balance less the beginning balance, and since they were all lined up one after the other, I just went ahead and copied that all the way until other current liabilities. Okay, then we've got long-term income taxes, long-term unearned revenue, and deferred income taxes. And why did I put these in? Because for some reason or other, these items right here, long-term, I think I showed long-term debt there. Yep. Then long-term income taxes and long-term unearned revenue. And then these deferred income taxes. Let's go see. Well, I put long. Yeah, no, this is okay. I would ask myself, do some of these items belong down here in financing? But I did put long-term debt down there. So for these, since they're liabilities, it's just going to be the beginning less the end. So that minus that right there for long-term income taxes. And once again, I want to emphasize the reason I'm only choosing items for which I use the base formula and which I did not hold constant. If you held them constant, the difference would be 0 anyway in the statement of cash flows, and it wouldn't make a difference. Okay, so I've got long-term income taxes, and you really have to do some investigating here. I'll put them in here now for now, but I think there may be an argument for putting them in the finance section. Okay, so for these long-term items, those look good. Okay, so, and what I'm doing is I have taken these 3 items right there and taken the differences between that column and that column right there. Now I haven't taken long-term debt because that definitely belongs to financing. Okay, so let's go across and see what we get here. Okay, we get, it looks good, I think. Okay, looks good. Okay, now, so we've got our changes in current assets, current liabilities. These, sometimes long-term items do go into the operations section. You'd have to really look at these. I think unearned revenue would. Deferred income taxes, it's immaterial anyway, it doesn't matter. Long-term income taxes probably goes here. Okay, let's add back our depreciation expense. Where do we get our depreciation expense from? Well, our depreciation expense is, this is why I do this, it's going to be the difference between the accumulated depreciation for June 2020 and June 30th, 21, and the depreciation for June 30th, 20, which should be, so we can do this here, $12,796, which should be for 2021. I may have picked off a wrong number there, I think. No, that's okay. And that number right there. Those numbers right there. There's my depreciation expense going across. I have a feeling I picked off a wrong number, but I'm just going to go with this. So, because it's this thing balanced. So it looks good so far. Depreciation expense is going up. And notice that it's just the difference between the accumulated depreciation for one year and the accumulated depreciation for the next. Okay, and then cash flows. So your cash flows from operations is going to be your net income plus the sum of basically everything else, plus the sum of, maybe the sum of all these things, but I like to put net income in a different place, plus the sum of all these things. So the cash flows from operations, I'm getting a different number here, and that is because this depreciation expense should be added back, so I'll just make it a negative. And there's the correct number, 53902. Okay, you should be adding back depreciation expense, obviously. Okay, and then we'll go ahead and add those back right there. Okay, and then we'll go down to the investing section of the statement of cash flows, and I've only got 2 or 3 more accounts left in the statement of cash flows. One would be the purchases of property, plant, and equipment, and the purchase of property, plant, and equipment are just going to be the gross property, plant, and equipment for 1 year, and this is really the net of the net, like net purchases, less than that next year. So that gives you purchase property, plant, and equipment of $20,169, and of course, since you're buying it, that should be a negative. Put a negative there, and then we'll take this out. And so far, so good. And the only other item that I need to account for is down in financing. So we've got investing. I'll put investing in bold here, and I'll put financing down here. Obviously, in financing is usually a pretty short section, but investing, you probably have some acquisitions or stuff. But this is a simplified version, obviously. Long-term debt, and keep in mind that long-term debt was on the balance sheet. Long-term debt on the balance sheet is that right there, and it's long-term debt, so it's going to be that. You're borrowing money, so that's that. So your long-term debt, you borrowed $9,950 there. Okay, and then we took it out there. Okay, so the change in the cash balance, let's check out the change in the cash balance should be equal to cash flows from operations plus purchases or minus whatever of property, plant, equipment, long-term investments, and we come to 43,683. Okay, and those are changes in cash balance. Now let's make sure that does equal the change in the cash balance. So let's go all the way up to the top here to the balance sheet, and we'll just check the first and the last ones. That number minus that number, because 43,683, and let's go ahead and we'll just do it by memory here with that. And so if usually you can see it's going up, let's check out that last one, 8955, and there it is right there. So the change in the cash balance in fact does equal the change in the cash balance does equal the amount right there. And I really did this here. So anyway, so the change in the cash balance, I'm going to shut this video down. I got lost here, pushed some key, and I forgot how to go hit home, that, or hit home. I don't know. Anyway, I'm going to put it up and we'll start again. But the change in cash balance to work. That's where I'll start. Okay, only 13 minutes.